Hello, I'm Mervyn Shanmugam, CEO of Alternatives at Sanlam Investments. Welcome to our educational series on alternative investing.
Hello, my name is Pawan Singh. I'm Head of Multi-Strategy at Sanlam Alternatives. So what are alternatives? Alternatives are unlisted asset classes like private debt, private equity, and real estate. And unlike their public counterparts such as listed equities, listed bonds, and listed real estate, they don't get traded on a public exchange, they don't get priced daily, and generally transactions happen privately between investors. And asset classes within the alternative space tend to be very illiquid. So why should one invest in alternatives? Well, one of the pioneers of allocation to alternatives was the Chief Investment Officer of the Yale Endowment Fund called David Swensen, when he took over the helm of the endowment in 1985. What started as a 10% allocation to alternatives or private market strategies, 20 years later in 2015 was about 70%. And this allocation was across a wide range of asset classes such as private equity, venture capital, private debt, infrastructure, renewable energy, and hedge funds. So what are the benefits that you get, from including alternatives in your retirement portfolios alongside listed assets? Well, one of the obvious ones is the exposure in private markets to risk factors is very different to what you see in public markets. And the catch-all phrase for this sort of risk premium is called illiquidity premium, where you expected to get a higher return and a higher uplift in asset allocation decisions because you're locking your capital. Another important reason to invest in this asset class is their low correlation to traditional asset classes, which basically helps you with robust portfolio construction. And something that has sort of started to gain a lot of traction is the ability to generate a real return. For the last decade or so, we've also seen the rise of impact-driven investments, where you can generate both a financial return and social return. So how do you do this? How do you go from a theoretical idea of including alternatives to practically doing it? And we believe that a diversified approach to private market strategies, much like the Yale Endowment Fund, makes a lot of sense. In fact, if you look across on the public market side, the growth of assets in multi-asset funds or balanced funds shows that there's a vast amount of benefit that's derived from asset allocation across a wide range of strategies. And we propose a similar approach to alternatives. Makes a lot of sense, where you blend yield-generating, income-generating, and growth-generating assets such as private debt, real estate, and private equity into one bucket. You actually look at an asset class which can start giving you a running yield from year one, but also gives you exposure to highly illiquid asset classes. And by approaching multi-asset allocation to alternatives in this way, it allows pension fund members in South Africa to actually generate long-term real returns, while also playing a very active role in the real economy in South Africa, where the need for capital is the most, but the availability is very limited.